Hey, what's up guys? My name is Grant, and welcome back to the second episode of Get Your Bread Right, where we're breaking down a couple of simple financial terms. Today we're going to be looking at the Dow Jones Industrial Average, or the DJIA. Also known just as the Dow Jones was created in 1896 in a merger between Charles Dow and Edward Jones, and they started out with just 12 companies. Today, it's a list of 30 blue chip stocks. So this is going to be high earning, consistently performing companies. And this index was created as an indicator for the health of the US economy as a whole. It's one of the most watched stock market indexes in the world, so it's similar in that way to the S&P 500. And it includes companies like Microsoft, Apple, Amazon, Visa, and others like that. Similar to the S&P 500, but it's just a smaller, more condensed list of the largest companies out there. Now, the Dow Jones composition can change over time given economic trends and the performance of an individual company. So if a company's not doing so hot, they might find themselves dropped from the Dow Jones. Some examples of this include in 1997, when Westinghouse Electric, Texaco Oil, and some other companies were dropped and replaced by Johnson & Johnson, Hewlett-Packard, and Walmart. We saw a move towards more technology, less of those large department store type things. So this is one of the reasons why, with such a short list of only 30 companies, when a company's not performing so well, they could find themselves dropped from the Dow Jones list. Another good example is in 1999, when Chevron and Sears and some others like Goodyear Tire were dropped, and Intel, Microsoft, and Home Depot, along with SBC Communications, were picked up in their place. So some critics of the Dow Jones will say that because it's only 30 companies versus the 500 in the S&P 500, it's not as good of an indicator of the economic performance. They believe that it's just too small of a sample size, essentially, to give a really good idea of what's going on in the broader economy. So now that we have an understanding of the S&P 500 versus the Dow Jones, you have 500 companies in the S&P 500, you have 30 in the Dow Jones. Let's talk about the historical returns, which are going to be very similar between the two. In the last 20 years, the Dow Jones has averaged a 10.1% return, which is very similar to the S&P 500, and this makes it a very powerful tool for investing. If you can afford to allocate a small portion of money to both, that's a good way to get exposure to the majority of the United States stock market and have the companies that are doing well make up for some of the companies who are not doing so well, and you still get that really nice averaged return. Now, the Dow Jones is priced a little bit differently compared to the S&P 500, and this is because of how the price is determined. In the Dow Jones, they use a price-weighted index, and in the S&P 500, they use a market capitalization weighted index. Now, a price-weighted index means that the individual share price of any particular stock, the higher it goes, the more impact it has, the lower it goes, the less impact it has, and maybe they get dropped off. Like we said earlier, some of those companies like Sears and etc. have been dropped off of the Dow Jones in the past in favor of newer, hotter companies. In a market capitalization weighted index, like the S&P 500, this means that the overall outstanding shares, which is the value of all the shares held by all the investors, determines the price. So we're talking about the individual stock price affecting its value, so the price per share, versus the value of all of the stocks together that are held by all of the investors together. So I want to thank you guys for joining me here for the second episode of Get Your Bread Right, where we talked about the Dow Jones Industrial Average, how the returns have been over the last 20 years versus the S&P 500, and the way in which the index is priced. Please leave a comment and subscribe, and tell me the type of content you'd like to see in the future, as well as any feedback. We'll see you in the next episode of Get Your Bread Right.